And pleasure having you in the studio. It's time now to turn to another conversation, and this is going to give you a holistic picture just ahead of the start of the earnings season. And Gautam Duggad, who is Director and Head of Research Institutional Equities at Motilal Oswal Financial Services, joining us this morning. Happy 2026 to you at the onset. I know that we're 8 days in, but we're speaking to you the first time in 2026, Gautam. What are the signs telling you? And you probably already gotten your notes prepared for the earnings season. Are you more bullish than you were at the start of the second quarter?
Hi, good morning. Thanks for having me. Wish you all a very happy new year to your entire team as well as your viewers. So yes, I mean, we are slightly more constructive than we've been for last few months. The single driving force behind that is the improvement in earnings that we're expecting. If you recall, last 5-6 quarters, we've literally done nothing on earnings. In fact, the entire FY25, we had a very flat year, 3-4% earnings growth. The first of FY26 was also slightly better, but nowhere near what we had gotten used to between FY20 to FY24, which was a period of 20% plus earnings compounding. So as we start CY26, the cumulative effects of the actions that the government and regulator has effected over the last 7-8 months, be it the GST cut, income tax rate cuts, interest rate cuts, the liquidity infusion, and various reforms that the government has announced, I think the impact will start getting felt from this quarter onwards. And hopefully, as we move forward in the calendar year 2026, it will strengthen further. So narrative around India, which had gotten a bit flat, I expect that to improve as we progress in 2026. In my view, this year should be far better than what we've seen in 2025. Fingers crossed, obviously, on global macro factors, the likes of US trade deal and all, because those are unforecastable parameters, but they hold huge sway over the market sentiment and short-term direction. As far as fundamentals are concerned, we are expecting improvement in earnings. In fact, this quarter, we are projecting a 16% earnings growth, which is the best that we have seen in the last 7-8 quarters for our coverage universe. Nifty still hovers around 7-8% growth. That's because the large sectors like banks, consumer and IT, which together comprise roughly 60-65% of the index weight, they are still meandering in that 5-10% kind of a growth zone. So the mantle of driving the growth is still resting on the shoulders of relatively smaller sectors like autos, consumer durables, capital goods and likes. But as we move forward in FY26 and FY27, we expect the earnings picture to get slightly better for India. Valuations have consolidated. I won't say they are cheap. Large caps are trading at 21.5 times, which is in line with long period average. Mid cap and small cap, after an underperformance of the last 12 months, especially small cap, they still look slightly expensive on an absolute basis. So valuations are still not screaming at you. But they have consolidated. Lot of froth, lot of excitement has gone out of the wind. So things are a bit more sober than they were, say, 6 or 12 months back.
Okay, so and you've given us a very nice roundup of that. I want to drill down a little bit on a couple of aspects, though, Gautam. And you're talking about a 16% bottom line growth that is penciled in. The question, though, a lot of people are asking is, this is has been in the past also driven by your margin expansion for a large number of companies. It hasn't been top line led. And so when does that take place? Does it take place in the fourth quarter, because it's unlikely to take place in the third quarter? Or do you have to wait till the new year with some of those base effects coming into play for that to take place?
Yeah, in fact, for Nifty, we are not expecting any margin expansion this quarter. We are expecting a top line growth of 11%. And EBITDA growth of 10 and profit growth of 8. So there is no margin expansion which is coming in as far as Nifty is concerned. The margin expansion is making its presence felt in our broader coverage universe, where our top line growth is 8%, EBITDA growth is 12, and profit growth is 16%. Now, your point is quite fair as far as the moderation in top line growth is concerned, but that's on account of two factors. One is a relatively benign commodity prices that we have seen for the last 2-3 years, and second, the relatively lower inflation that we have seen as a consequence in India. What it has done is just pulled down the nominal GDP growth in the 8-9% handle versus the 12-13% that it used to trade at. So obviously, it's going to have an impact on the corporate revenue growth. Now, margin expansion we've already seen to a fairly large degree in FY24. After that, it's been a very mixed picture on margins. Some sectors have done well, some sectors have not done so well. If you look at a full year picture, you're still talking about 8-9% earnings growth for Nifty, which is broadly converging with the top line growth. So there's no big margin expansion that we are seeing this year in Nifty. There is some margin expansion, as I mentioned, which is there in the broader market, given the sector-specific dynamics. Fair to say that 15-16% revenue growth, the bottom line growth that we're expecting in FY26 might continue in FY27 as well. So I won't expect any big pickup in top line growth unless we see a change in trajectory of inflation or change in trajectory of nominal GDP growth.
Gautam, hi, morning, Tamanna here. Just want to get into a little more detail on maybe the BFSI space, and you talk about a layered stance on what is going to happen here. You earmark grow. What's going to happen this quarter also, interestingly, we're going to see some of those marquee IPOs present their numbers, and a little more deep dive on it. Grow, I think Misho as well. Why are you pinpointing grow? First of all, and what do you think is going to be the move on BFSI? We've seen private banks, meander a little, maybe because of fears of more rate cuts.
Hi, Tamanna, good morning. So look, on BFSI, we've had a very clear stance for more than a year now. If you split the whole BFSI segment, and we cover 70 companies in BFSI, so we have private banks, PSU bank, then you have NBFC lending, and the entire capital market / NBFC non-lending space. Our view on banking has been very clear. We are more constructive on PSU bank versus private banks. So if you glance at our model portfolio, you will see underweight stance continuing in private banks. In fact, we've trimmed HDFC Bank bit further by 100 basis points and invested that in SBI. So PSU banks, they are very sanguine. They are still very reasonably priced. ROEs are trending upwards of 15-17% for fourth year in a row. Credit costs are as good as what private banks have been reporting, and growth is almost converged with the private banking so far as advances growth is concerned. So there the stance is very clear. Within the overall neutralish banking stance on model portfolio, overweight on PSU banks or private banks. What we like on an absolute and a relative basis within the financial space, however, is the NBFC, both lending as well as non-lending space. So on non-lending, we've been very, very constructive for more than 2 years now. In fact, it is one of the biggest themes in my view, if one were to construct a portfolio from a 3 to 5 year perspective. The whole capital market ecosystem is coming alive, not just brokers, but even exchanges, wealth managers, asset management companies, intermediaries, depositories, what have you. Now, within that, you have to pick and choose, obviously, because we have a constraint in model portfolio. Usually, I don't go if I stock. Otherwise, I would have put more stocks from capital market space in our model portfolio. Insofar as growth is concerned, we just put out our initiating coverage report a couple of days back.
Can I ask you which ones got left out? Can I ask you which ones got left out from the capital market space?
Probably I would have added an exchange or one more AMC there. Right now we have Aditya Birla. Maybe I would have added another AMC there, or maybe another wealth manager there. So you have a whole ecosystem of capital market space listed in India now, which was not the case 5 years back. So today, a choice which is available to an asset allocator is very diversified. I mean, if you go back 10, 15 years, you didn't have a single insurance company listed, you didn't have a single AMC listed, and there was nothing called as capital market space those days. So you had to only make a choice between a private and a PSU bank and NBFC. Now, obviously, as we've come over the last 10, 15 years, the whole financial spectrum has evolved, and maybe in fullness of time, say next 2-3 years, you will have far more choices within the existing spaces as well as the new fintechs which are going to come and list. So yeah, I mean it's a very interesting space which is evolving. Within that whole construct, as I mentioned, and at the cost of repetition, we are far more bullish on capital market ecosystem than the core plain vanilla banking space.
Gautam, good morning, Neeraj here. I have one question, and one question, right, and then which is that which are the businesses which, if they deliver in the quarter as per what you estimate at the current valuations, are still primed for an investment? I'm not asking for necessarily individual names. What I'm trying to get from you is the cohort where you are most constructive on if they deliver as per expectations.
So Neeraj always asks the most difficult question. Look, Neeraj, the valuations that we are at today, despite the very tepid returns that we have seen over the last 12-15 months.
Right.
As I was mentioning earlier in the conversation, the absolute valuations are not screaming at you still. Your mid-cap index is still trading at 24 times, small cap index somewhere close to 27, 28 times because the earnings has been lacking, and large cap at about 21 times. So we are today not in a situation where a sector with a minor surprise or just about meeting expectations will result in a blowout return. Having said that, I'm far more constructive on tech today than I have been 3 months back. In fact, in the middle of November, we upgraded the entire technology space, raised our target prices estimates, and changed the stance in model portfolio from underweight to overweight. This is the space which is most neglected right now, and perhaps for the right reasons also, because we don't have a say in AI, narrative right now. But you look at the fundamentals and also some of the sentiment-related factors, you will find that the growth has been around 7-8% in so far as earnings is concerned for large cap IT and around 15 to 17% for mid cap IT. Second, the positioning in tech is the most lightest that you've ever seen in the last 5 years. The weighted index has gone down from 20 to 9% in the last 5 years. Out of 20 top mutual funds, if I'm not wrong, 80% of the mutual funds today in India, and because we get this data every month and we publish a fund folio report, very detailed fund folio report on that, 80% of the funds have an underweight positioning in tech, right? So even a minor bit of a positive surprise or the sector just about meeting expectations can result in some, differentiated returns out there. So in a way, I'm saying that risk reward is very attractive in that space today than what it has been 2-3 years back, right after the COVID. So that is where we have changed our stance materially amongst the big sectors. Second, where I feel momentum could continue, the expectations are high, obviously there. Sector has done well, but it can continue to do well is automobiles, right? Even in this quarter, we are expecting 25% earnings growth in auto, with both two-wheeler, four-wheeler contributing to the party. And our positioning is very clear there. We like M&M, Maruti, TVS, which has been in the which is part of the model portfolio for a fairly long period of time. And they've been the biggest beneficiary of GST. I mean, you go back 3-4 months when the GST cuts were announced, everyone was expecting big returns across the space, big pickup in volume growth and all. But now, with 3-4 months after GST, if you look at the hardcore numbers, you will find that auto is the only sector which has so far benefited from the GST reductions. Consumer companies are still talking about 3-4% volume growth, or maybe even lesser if you look at the bigger consumer companies. So the single largest beneficiary of the GST reductions in India has been automobiles, and that is where we have seen earnings upgrades also happening, momentum continuing month after month, and they have also been a beneficiary of a good festive season, plus a wedding season, and of course the price reductions that have happened as a consequence of GST cut. So that automobile is one space where I will have a very, very sanguine view, and I will expect the sector to continue to do well even from here.
Well, Gautam, so this is always great talking to you because you get a great numbers-based indication of what could happen. What I would urge is that while I know we'll do a conversation at the end of the quarter, we should do something mid-quarter as well, just to get a sense of whether quarter 3 is going as per plan or no. I urge you to think about that somewhere in the last week of January. It might be great to do a conversation once 40-50% of the earnings is out of the way.
Let's do it once we do the interim review in the first week of February, and the budget would have also.
Perfect. Sounds good. Sounds good, Gautam. Lovely, lovely. Look forward to that.
Yes,
thank you and have a great 2026.
You too.
All right. That's the view from Gautam Duggad of Motilal Oswal. And let's see, specific pockets might do well. Maybe the market at large might be quiet. But one pocket which should do well, presumably because of the kind of footfalls that have happened in the movies, is PVR Inox, right? It's ended 2000.